All right, today we're pulling back the curtain on quantitative finance. We're going to crack open the professional's toolkit and see exactly how they use numbers to understand the past and try to predict the future. Let's get into it. So it all boils down to this one big question, right? In a world that's just drowning in data, news, and noise, how do you find the actual signal? How do the pros systematically turn all that raw info into smart, calculated decisions? Well, the short answer is they don't just guess. They rely on a really powerful and precise set of mathematical and statistical tools. And we're going to follow that process, starting with what's already happened and working our way all the way to the cutting edge of modern finance. Okay, so our first stop is figuring out what has already happened. It makes sense, right? Before you can even think about looking forward, you've got to have a really accurate way to measure the past. This is all about calculating returns. Let's start with a super common scenario. You buy a stock, you get a little cash from a dividend, but then, the price drops. So, did you actually make any money or not? To find out for sure, you need the right tool. And the tool for this job is called the holding period return, or HPR. It's a really simple but powerful formula that rolls everything into one single number: the change in the stock's price and any income you got, like that dividend. It gives you the complete, honest picture of how your investment did. And the final answer? A loss of 10.1%. See, that dividend helped a little. It cushioned the blow, but it just wasn't enough to make up for the price drop. The HPR cuts right through the confusion and gives you that one clear, unambiguous number. Okay, now for something a bit trickier. Investment returns are almost never a smooth ride. They're choppy, they jump up, they fall down, and if you just take a simple average of these numbers, you're going to get a really misleading idea of how your money actually grew. So how do we find the true compounded growth rate? For that, you got to use the geometric mean. A simple average is totally wrong here because it doesn't account for the effect of compounding. The geometric mean, on the other hand, is built for this. It finds the single, steady growth rate that would have gotten you to the same end result. And in this case, after all those ups and downs, the real growth was just 0.18% a year. All right, we figured out how to measure the past. Now for the really cool part, using math to look into the future and figure out what something is actually worth today. This is the heart and soul of valuation. Let's start with a classic bond problem. A zero-coupon bond is simple. It pays you nothing for years, and then one lump sum at the very end. So, what would you be willing to pay today for a promise of 100 rupees 20 years from now? The answer is all about present value. This formula is like a time machine for money. It takes that future payout and tells you what it's worth in today's money. Given a 6.70% yield, that future 100 rupees is only worth 27.33 rupees if you buy it today. That right there is the time value of money in action. Now, what about stocks? They're a whole different animal. Unlike that bond, a stock could, in theory, pay you dividends forever, and those dividends can grow. So, how on earth do you value an infinite, growing stream of payments? We can tackle that with something called the Gordon growth model. It's a really elegant way to handle that infinite growing payments problem. First, you just project next year's dividend. Then you plug it into the formula, and boom, you get a fair price of $49.44. It's a solid, numbers-based way to value that stock right now. So we've covered returns and value. But here's the thing, the future is never certain. So the next set of tools in our kit is all about measuring, understanding, and managing the one thing that's always there in investing: uncertainty. You know, there's no single way to measure risk. The right tool really depends on the question you're asking. For example, if some crazy one-off event is messing up your data, you might use a trimmed mean to ignore it. If you only care about the risk of losing money, you'd use something like target downside deviation. Roy's safety first ratio helps you find the portfolio least likely to drop below a number you can't afford to lose. And then there's amazing stuff like Bayes' formula, which lets you mathematically update your opinions when new information comes in. Each one is a different lens for looking at uncertainty. Look, having a great investment idea is one thing, but you have to test it. You have to see if it holds up against the actual data. This is where we shift from just calculating things to actually validating our ideas. And when you test any strategy, there are two classic ways you can be wrong. A type 1 error is a false positive. You think you found a genius strategy, but really it was just dumb luck.
A type 2 error is the opposite, a false negative. You miss out on a genuinely great strategy because your test just didn't catch it. Knowing the difference is absolutely critical.
Analysts are always building little models like this to try and predict things. So this one suggests that a company's return on equity, or ROE, is connected to its growth opportunities. So if we know the growth number, what does our model spit out for the ROE?
The model predicts an ROE of 22%. Simple enough. But a prediction is only as good as the model that made it. That's where a statistic called R-squared comes in. It basically tells us how much of a company's ROE is actually explained by its growth. Think of it like a confidence score. A high R-squared means the model is a good fit, a low one means, meh, something else is going on.
Okay, so we've covered the classic foundational toolkit, but the world of finance is moving at light speed. So let's wrap up by looking at the insane new tools that are really defining the future of how we analyze investments.
Machine learning is incredible. These models can sift through mountains of data and find patterns no human could ever spot. But they have their own unique problems. For instance, what happens when a model learns its lesson a little too well?
That is a classic problem called overfitting. The model basically memorizes every little quirk and bit of random noise in the data it was trained on, instead of learning the real underlying patterns. So it looks like a genius on the old data, but then it completely falls apart when it sees anything new. The real art is building models that can generalize, not just memorize.
And what about all the data that isn't just numbers? I'm talking about news articles, earnings calls, social media posts. That's where natural language processing, or NLP, comes in. These are models that can read and interpret human language on a massive scale, letting analysts spot shifts in mood and sentiment, sometimes even before the market does.
So from the simple holding period return all the way to machine learning, the financial toolkit just keeps getting bigger and more powerful. But as the models get smarter and the data gets faster, it really all comes down to one final question. What's the one timeless human skill that every investor is going to need to actually use these tools well? That might just be the most important variable of all. Thanks for watching.